All right, and tonight's lecture basically is what could have been used for today with the framework it gave you for euro going up into its imbalance. And the visualization of the trade framework is such. We have a fair value gap. Now, we're going to assume that the fair value gap is over here anchored, so the necessity of all the other candles is not important. Or it could simply be used as an old high. So interchangeably, this can be one of two different frameworks. You can either use this with the fair value gap, which is kind of like what I'm teaching, so you can look at the euro dollar with this idea that transpired today, or take the fair value gap idea out of it and just simply use the old high, and it would be basically the same thing. Okay, it's a premium array. The market's likely to draw up into that. We're looking at a consolidation, and the market obviously has been in consolidation in euro, but at some point, as I mentioned with Powell speaking yesterday, that was the reason why I felt that dollar would be heavy. It would trade down to its discount fair value gap, and euro would trade up into its premium fair value gap. So if we have that logic here, we're expecting the market to draw up into here, and we have a down close candle, and the next day we have an open, and we open above that down close candle, potentially bullish order block. If we trade down into that order block there during a kill zone, preferably New York, I got a few emails asking for, can you talk about swing trading? Can you talk about how that works? Because I don't like all your intraday stuff, and they don't mean it to be disrespectful, but they have a swing traders model. Well, we're not in swing trading territory, folks. I mean, I hate to say it and sound like a broken record, but I'm giving you what's likely to happen based on what the markets are doing. For me to talk about swing trading when the market's simply not going to be swinging, it's kind of pointless. I'm giving you things that you can use right now that's tangible, that is most salient because of the current market environments. So, again, any one of these things that I'm teaching you with this framework, they're like Legos. Okay, you ever seen the little plastic blocks that children play with, and you snap them together, and you can put one on top of the other, snap them together, and you can build larger things. Each one of these components, this framework, can be utilized as a smaller segment or entry pattern to a larger swing. Each one of them can, individually. Or they can be viewed as an individual isolated trade setup. So I'm teaching swing trading entry techniques by doing this. I'm teaching position trading entry techniques by doing this. I'm teaching you day trading entry techniques by doing this. I'm teaching you scalping entry techniques by teaching this. Okay? This logic over here is 100% scalable, just like this is. Okay? But you have to understand what you're looking for, why it should be even potentially possible for a position trade, a swing trade, a short-term trade, a day trade, a scalp. So you have to have that logic, and that's what I'm leaning on. I'm providing that experience, telling you the market's consolidating, don't do anything. The market's likely to lead the consolidation last night when we did our commentary, and it did. Okay, so let's hope, for those of you that want a little bit longer term perspectives and things like that, let's hopefully move outside these consolidations and start seeing some swings. But it's not swinging. Okay, so, I know the frustration, but also I don't like when I'm reading emails and there's this undertone of this sense of urgency. I'm about to quit. I'm getting frustrated. Well, the reason why I tell you don't engage right now, so that way you spare yourself that frustration, because the markets are very fickle right now. It's very difficult. It takes a lot of experience to be able to navigate that, which is the benefit of being here. But if you take a step back and look at what's been going on for the last year or two, I'm helping you navigate. But you can't expect to be doing what you want to do and trade like how you want to do, or trade how you envision yourself trading, when you can't do it because the markets are not likely to develop like you want them to. Okay? So put it this way. A mega trade. Everybody wants to capture a big old move like that. But there's not a mega trade forming right now. You get the logic there? So just because you want to do something and you feel a sense of urgency doesn't make it possible for you to do it. So when you look at these components like this, individually and isolated, just know that they also can be plugged into larger price swings. And then when you incorporate the swing trader's logic that I teach in the core content, it's complete. This is plug and play. I mean, I'm giving you trade framework. Every single one of these is a potential entry technique to anything that you want to do, scalping up to position trading. But you have to have a market environment that is conducive for those things to occur if you're looking for position to swing trading. We aren't there yet. Okay. So anyway, back to this. The framework is this: we open higher than the down close candle with the expectation that we're going to draw up into the fair value gap or old high. So either one could be the framework here. But we've consolidated basically, and we have an opening when we've been expecting higher prices. We open higher than the previous candle. So we expect it to trade down into the order block here, accumulate longs, and then reprice into the fair value gap, or if it's not a fair value gap there, just above the old high. Okay. So we have a 15-minute time frame. It's consolidating. Okay, it's waiting for news, like we had today. I mentioned last night that today we would see a CPI number. So we've consolidated, waited for that CPI number. Prior to the CPI number, we had a short-term little break in market structure, and then we trade back down into a breaker, as I mentioned in the Euro-dollar commentary. That would be seen like this. Okay, so we have a bullish breaker, low, high, lower low. Find the high in the middle, extend it out in time. If we trade into that during New York Open, so we have New York Open kill zone, we have CPI number coming out, and we have the expectation of that daily fair value gap, which is exactly what I outlined for you last night. Said we would trade up into that today. Bullish breaker, New York session, CPI number, the catalyst runs right into it between 10 o'clock and noon. Okay, between 10 o'clock and noon. Let's go back up and look at the 15-minute time frame on Euro. Here is noon. There's the top of the premium high on the fair value gap, and that's the order block opening on the daily chart. It fulfills it right at the time I teach you, 10 o'clock to noon. Okay, so that's that logic there. Now, you may not have traded this. I can tell you I would have traded this, but I did not trade this because we're in January. But if we were in February, March, April, May, even June, I would have taken that trade right there. Okay, with the expectation that we ran higher. Because we had clean lows taken out and an imbalance filled in here, sell side taken, and we accumulated around that daily bullish order block. And we're inside that old hourly fair value gap. Premium high, discount low, that's this levels here. So there's a lot of lines in here that's overlapping, and I apologize if it's confusing for you, but those lines are simply this, that old imbalance here. Okay, so it's accumulating there, and this opening price right there, extended out in time, that's the heavy blue line that you see there. Okay, that's what that is. So with that in mind, we're accumulating around that old daily order block inside of an hourly imbalance. Okay, then we have a break in market structure, this swing high taken here, and then fills in the imbalance with the fair value gap and a bullish order block, trades there at 8:30, and then rallies. Now for entry technique, say you wanted to be a day trader and you saw that it traded down here. And this is a 15-minute time frame. So as soon as it traded down there, you could put a buy stop right at this wicks high plus 1 pip. So if it trades back up there, it fills you on strength, and your stop would be below here. So there you go. That's Larry Williams type entry where he buys strength. That's the only way that that's going to work. I tried to do it other ways when I was coming up in the 90s, and I got smashed. Using buy stops and sell stops as my entry technique when I didn't understand what the market was doing was just dismal. But this is one entry technique that you could use with that idea and not buy on a limit. you would expect, or kind of like a confirmation entry technique, where it's giving you what you would expect to see it fulfill as a retracement order block, but it demands the market to trade there. And you might get some slippage. That's the only problem with those types of orders, especially during high impact news, CPI number. It could give you a little bit higher entry than you really want. So that's one of the trade-offs to buying strength versus buying weakness in an undertone that's already bullish.